Seriously, I'm not bored anymore, Doug. We got enough to talk for at least another hour.
Thank goodness for that, because we don't usually typically try to go longer. So good for
Yeah,
us.
next week's a different week though. We'll
That's
see.
right.
But this week was busy. So yeah, so this week we had a lot of stuff going on. We had the Federal Reserve FOMC targets. We had earnings. We had lots of stuff. So I want to bring up this. We said this last week, but this is, in my opinion, the busiest and most important week of earnings season. Um, I would say the second most important is probably the first week when you have all the banks reporting because they tend to give you an indication of what's going on in the economy. But this week we had a whole host of companies report: Coca-Cola, UBS, Visa, Teradyne, Ford, ADP, Boston Scientific, and then you had the big tech companies, which are the more important ones. You had Microsoft and Meta on Wednesday, and then you had Amazon and Apple on Thursday, which, out of the Mag 7, you got half of them right there. But anyway, so what's important to take away from this is there was a huge amount of earnings this week, huge amount of volatility. And, I wanted to share something I've started to notice. And I only share this because I just find it weird. Okay. So, when times are good, when the market is operating normally, what you would typically see is you'd see most things go up, right? Earnings come out, things go up. Bad earnings, they don't go up as much, or maybe they're flat, maybe even down a little. But you don't see any really bad news, right? You don't really see that very often. But when things are a little different, when the markets are going sideways or the direction's a little hard to determine, you start to see this. Okay, this is two companies. I didn't label them, so I'm just going to say there's four companies here. There's Microsoft and Meta, and then there's Apple and Amazon. And I believe this one is Microsoft and Meta. Yeah, I got the tickers in here. All right. So what we saw this week was Meta went down a reasonable amount, and then you had Microsoft, which went up a reasonable amount. Actually, Microsoft went up a lot. Went up, I think, like 15, 16% after earnings, which is a lot for one of the biggest companies in the world. Meta did not look good. And then you had Apple and Amazon. Well, Apple was, let's see. Yeah, it was Apple and Amazon. So, when you look at these, what do you see? You see two big tech companies basically canceling each other out, right? And I've seen this a lot more. When times are good, everything kind of goes up. Maybe it goes up a little bit. But when you have like big ups and big downs, it ends up canceling each other out. And this is kind of one of these tinfoil hat topics. I don't really have any proof, but more of just isn't that interesting kind of a comment. So what we're seeing so far with earnings this week, you're seeing a lot of volatility. You saw the NASDAQ, which you talked about last week, was in a trading range and actually broke below the trading range. And then we had a story out yesterday about Citadel cleaning out this young whippersnapper hedge fund genius who what was the name of his fund, Doug? I don't know if you remember this guy.
I forget the name of his fund. Yeah, but boy, did the Citadel eat him up. Hold on, I'll look that up for you. Go ahead.
Yeah, I actually, yeah. So it was something along the lines of intuitive perspectives or something like that. Doug will get it. But yeah. This young guy basically had a hedge fund. He turned 200 million into like 6 billion. And in a short period of time, all by investing in basically AI. And apparently, and this is all secondhand. So
Kirk, it's Leopold Aschenbrenner's Situational Awareness Fund.
You couldn't come
up. Which could not be more ironic.
It couldn't. Yeah, I actually sent out a few posts yesterday about the irony of this guy's name. Situational awareness. Okay, this young guy's fund's name is Situational Awareness, which he got blown up because of his lack of situational awareness. So I'm just explaining this for those of you who don't understand the irony. He turned 200 million into like $4 or $6 billion in a short period of time by not only investing in AI, but being like 4x leverage or some crazy number. And he got blown out because in Wall Street form, Wall Street knew what he was doing, and they knew he was leveraged, and they said, you know what, we need some free money. So they blew him up, which I think was like Wednesday or Thursday. I think it was Wednesday. They blew him up Wednesday, bottomed out some of the tech companies, and I heard Citadel bought his assets for like 40, 50 cents in the dollar. This is what Wall Street does. So when you say, well, it's not fair because insider, you know what? Have you ever seen the movie? What was the movie about Dumb Money? I think this was called. And basically you show the hedge fund guys clean each other out, and then you see the retail public clean out the hedge fund guys. That's what Wall Street does. It is a bunch of sharks trying to kill each other. They're trying to eat each other.
By the way, they bought it for 10. Citadel bought it for only $10 billion, which I can't remember how much it was worth before. But one of the memes, somebody has an AI generated image of Sam Bankman-Aschenbrenner.
Yeah,
if anybody gets the joke.
I mean, it's just priceless. The whole situation's priceless. You couldn't ask for a better story. I mean, this will keep me laughing for at least a week. I mean, and if you look at this guy, this guy's headshot looks like Dracula. Like a theatrical image of Dracula. Like it couldn't have been funny. It really couldn't have been funny. But anyway, the point being is when you hear this stuff, people say, well, that's Wall Street, blah, 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 rich guys. You know what? Rich guys fighting each other. This is sport. This is like going to the Coliseum and watch rich guys, throwing swords at each other. That's great. I'll watch that all day. I don't think that's a bad thing. I think that's what Wall Street's about, and I think it should be. What I don't think it should be about is Wall Street getting away with stuff at the benefit of individual investors in ways that are not legal to begin with. Let's put it that way. If Wall Street is getting at each other's throat in a totally legal way, go at it. I don't care if you're doing it to individuals in a legal way. Go at it. But the problem is when Wall Street goes after individuals in an illegal way, and then they don't get prosecuted, kind of like, what was his name? Fauci. Like we saw this week.
Could you repeat that again?
Fauci.
Like one more time?
I got something in my throat.
Two more times. Two more times. I need to hear it a fifth time in order to understand it.
I played the fifth. 1, 2, 3, 4, fifth. If you haven't seen Dave Chappelle's skit, by the way, I'm a huge fan of Dave Chappelle. He's the GOAT for comedians. And he did this thing called skit comedy back over 10 years ago. And he only did 2 seasons because
it was so
basically they took advantage of him. And he just said, screw you guys, I'm going to Africa. And I give the guy a lot of credit for just standing up and saying, screw you guys, I'm taking my ball and going home. I don't like the game. And he came back and he's twice the GOAT.
He walked away on principle,
he walked away on principle, and he came back twice the GOAT because of it, because everybody respected him. But his sketch comedy, nothing competes. Mad TV and Living Color, great, doesn't compete to Dave Chappelle. Like, he was so good. He has this one skit where he basically talks about how, people go in front of Congress and all the rich guys go in front of Congress and then they get away with a slap in the wrist or nothing. And he has this thing where he goes up and he's like, yeah, Mr. Chappelle, you sell crack? He's like, I plead the fifth. Out of all the amendments, the one I like the best is the fifth. He turns it into like this comedy skit, and it's hilarious. And what I find most interesting is most people see somebody going out there, like, yeah, he's getting what he deserves. You know what? If you're going up in front of Congress, it means you're getting away with it and you're not going to jail. Because people from the Biden era, some of them have gone to jail. They didn't go in front of Congress. So if you go in front of Congress, it means you're getting away with it scot-free. So it's too bad. I don't know if Fauci committed crimes. I'm not a judge. I'm not an attorney. Sounds like he did some crazy shit, and especially in the AIDS era. I know he did because I know some people around then and said, yeah, he did some crazy shit. But whatever. It is what it is. He's getting away with it. He's not going to jail. So all of those of you who listen to the show who want him to go to jail, too bad he got away because he went in front of Congress. That's just how the system works. It's too bad. It's too bad because Congress is it's meaningless. It's like going to the Coliseum. It's bread and circus. You're throwing bread to the crowd to make them cheer for the gladiator fights. That's all it is. So anyway, that's my 2 cents for the week. But that's when I see the shenanigans that go on out there on Wall Street, I'd rather see that because at least there's some rules with politics. I think it's all a game. It's all show. It's all theater. There's nothing real going on there. But anyway, so yeah, a lot of stuff going on. Earnings season. We'll see. I mean, yesterday was a big day in the markets because I think after the blowout, everything started to go up. But today's kind of sideways. So we'll see. It's the last day of the month. We'll see what happens first few days of next week. I think it'll be telling to see if because basically what happened was we crashed below support in the trading range for NASDAQ, and then we bounced back up to support. So this is actually, for those of you, after Doug's talking, I'll share the chart. But after, for those of you who are interested in technical analysis, this is actually a really good time to pay attention. If you look at the S&P, the S&P is still within a trading range. It's right around the middle, actually, so it's really uninteresting. If you look at the NASDAQ, it's below it's right at the edge of the trading range. You could argue whether it's above or below, but right now it went below, and then yesterday it kind of looked like it popped up, but now it's just kind of sitting there. So if next month, meaning Monday, Tuesday, Wednesday, starts where things start to go up, that's actually a bullish sign that the NASDAQ's going to go back into its range. If it starts down, it means that the range is broken and we're probably heading a lot lower in tech. And for those of you who think AI is just going to the moon, this is a really good chance to determine whether it's going up or down. If it starts to go down, it's a bad sign, a very bad sign. If it goes up, then we're back into AI bubble territory again, where everything's great and there's nothing wrong with AI. So those are things I would watch for next week. I'm not particularly bullish or bearish on AI. I think it's overexpensive, but everybody loves it, so I don't think it's going anywhere. But especially with Anthropic and OpenAI going public at some point, they can't crash that quite yet. You got to have a market for that stock, for the rubes to overpay for that kind of stock. I wouldn't touch it. I would never recommend it to anybody. But I'm sure it'll do great. I just wouldn't touch a 10-foot pole. So Doug, what are you seeing this week?
Well, hey, it's gotten interesting. I mean, if you glance at the service level indices, it looks like a typical standard summer chop. But I think if we get beneath the hood, this week was an absolute unmitigated battlefield. I mean, we are witnessing potentially a historic structural split across global liquidity, monetary policy, and corporate earnings. And if you have an active pencil in this market, you might need to throw out the first half of your playbook right now. Really, I mean, first of all, let's just talk about the $1 trillion bipolar tech scoreboard. In the past 18 months, the market consensus was simple. Big tech, they could spend boundlessly on artificial intelligence infrastructure, and it was fine as long as baseline revenues ticked up. But this week, that handshake agreement officially died. We've moved from an era of blind AI hype to, cold, hard execution metrics. I think there's a fracturing in the tech sector right now down the middle. I mean, on one side of the level, you've got some absolute execution masters. We have watched, and what's interesting is these have, I think there's some pattern here, right? First of all, it's Microsoft, software company, right? And their stock had been getting beaten up while the rest of the NASDAQ had rallied over the last, year or so. Microsoft's had a lot of head scratching. But the thing about Microsoft, we talked about this last week, they can't figure out how to price software. Look, if I'm a betting man, the one thing I will, that I would have a hard time ever betting against in the long run is Microsoft. No matter what happens, they always seem to come out in a strong position. Now that could change, but I mean, Microsoft has had, obviously has gone through multiple CEOs now and chairman since Gates left. And ultimately, if we look at where the markets, where technology was in the 70s, and 80s, when Microsoft really took over as the operating system of the PC universe. And of course, every time people call them dead, they continue to evolve in a way that proves that they're still a strong leader. They completely relieved the planet semiconductor sector by delivering a stunning cloud report. They've got something called the Intelligent Cloud. It brought in $31.4 billion with Azure accelerating to a 33% year-over-year growth. According to Investopedia, MarketWatch, Wall Street, ended up rewarding them, by printing the single largest single-day market cap expansion in financial history. They tacked on $450 billion in value in one trading session. It's incredible. Another one out there is Amazon. They closely mirrored the same playbook. They surged 13% after AWS reaccelerated to an annualized revenue run rate of $115 billion. Here's the thing. We've got a world out there right now that's trying to expand data centers. Microsoft and Amazon are in a uniquely strong position because they already have those data centers. They've had them forever. Microsoft was way ahead on the cloud. I remember people talking about the cloud back in the 90s, and people were just kind of going, huh? Well, guess what? They began investing in that and transitioning to this thing called the cloud back way before anybody was really thinking about it. And Amazon, I know it's fun to go there and get your stuff, to order it today, and some of it's there by 5:00 p.m. But the reality is that's never been the moneymaker for Amazon. Amazon Web Services is their moneymaker. That is their cloud. It has been absolutely the area where they've been able to be successful. And that, their CEO, Andy Jassy, defended their immense capital expenditures, noting that Amazon simply can't build data centers fast enough to satisfy the enterprise demand. And ultimately, they're already leading that. But on the other hand, you mentioned already the dark side of the scoreboard, where you look at any minor guidance miss or structural strain ends up with swift absolute obliteration. We have talked about this one. Why was Apple continuing to look so good when they have not evolved revenues, profits, or anything really of technological advancement in a long time? Apple's suffering from the same problem a lot of companies have. Their innovative founder died, but even though he built that company on innovation, he had his trusted circle around him, the people that helped to make the structure. Cook, right? Tim Cook. Well, natural elevation to CEO. Tim Cook is not an innovator, and that you've seen this. So they actually went through a bloodbath last week. They pledged 9%. This morning, or it might be yesterday morning, but they pledged 9%, erasing a staggering $373 billion in the market value in a matter of hours. Institutional desks just dumped the stock over a major revenue miss in Greater China. You couple that with warnings that global supply chain constraints are going to force hardware price hikes and squeeze future device margins. That's not good. Meta, on the other hand, similar fate, tumbled 10%. Their infrastructure spending has officially hit a cyclical trading point. Their CapEx consumed nearly 100% of its operating cash flow this quarter, $31.1 billion in capital spending against only $31.9 billion in cash generation. The takeaway, massive. Tech is losing its identity as a high-margin, asset-light sanctuary, and that is a massive component of what is driving our market. Has been the Mag 7, and so it's now beginning to mature and transform into a capital-heavy industrial utility business. And when you look at the energy sector, that strain is going to turning literal. The largest electrical grid operator in the eastern U.S., called PJM Interconnection, just revealed that its power supply capacity auction prices, they skyrocketed 800% because the tech giants are outbidding local municipalities for basic electricity to power these data centers. By the way, think about that for a second. These municipalities need basic electricity, and they're being outbid, causing power capacity prices to rise 800%. Think of the trickle down for a second of what that does when your municipalities, which can't print money, end up having to think about what they're going to have to do to make this up. Property taxes, cost of the electricity, just the residential, huge ripple effect. Second collision, we got a hawkish Fed hold and a Warsh bond tantrum. We talked about it a little bit last week. Equity traders, they've been hyper-focused on Apple versus Amazon. The fixed income desk, hey Kirk, which desk tells what's really going on under the covers? Oh, it might be the bond desk.
Smartest investors in the room. Bond
100%. Getting entirely upended by the Federal Reserve. They left interest rates unchanged in the July meeting. It's the longest. It's the longest they've left it unchanged in a considerable period of time. I can't remember the details on that. I'll try to find it. But I think the real story is the immediate violent internal fracture. 3 out of the 12 voting members directly dissented, casting formal votes for an immediate interest rate hike. So, Trump has been asking for an interest rate cut inside the Fed, even though inside the Federal Reserve, even though they kept it, they held the rates. The actual story inside is that 3 of the members wanted to raise them. That is exact opposite of what the current administration wants. So when the new Fed chairman took the podium, he sent a shockwave through the bond market. Instead of calming the waters, he actually injected massive policy uncertainty. Hey, Kirk, what are the markets like? What helps the market stability?
Certainty.
Yes, certainty. So that did not help. Actively introduced doubt regarding willingness to tolerate structural inflation to protect asset prices. The bond market threw that instant tantrum. Long-dated yields skyrocketed. They drove the 30-year U.S. Treasury to heights we have not witnessed since 2007, pre-Great Financial Crisis. So when the long-term risk-free rates spike like that fast, it ultimately changes the math for everything. It forces a mechanical re-rating of equity multiples. It freezes corporate refinancing windows. It expands high-yield junk bond spreads over treasuries to the widest premiums in 14 months. Small and mid-cap companies facing massive debt maturities over the back half of this year are suddenly going to find the debt issuance window freezing completely shut on them. And I think that's really important for us to look at going into third and fourth quarter. On top of that, we've got the worsening macro stagflation trap. All the corporate and monetary volatility, that's crashing headfirst into a macroeconomic backdrop. It's now turning distinctly stagflationary. We've looked at this for a couple of years. We've been talking about it, but we haven't quite gotten into that point because the markets, they've been really hot, but interest rates, and inflation have kind of been a little bit calm. Watch the energy markets, because that ripples through everything in terms of cost. So the Bureau of Economic Analysis dropped a bomb this week. They revealed the U.S. economic growth decelerated significantly, printing a 1.5% GDP expansion rate for Q2. And guess what? That missed Wall Street's 2.0 consensus expectations by a large amount. At the same time, you got personal consumption expenditures. The Fed's PC, which is the PCE, the Fed's absolute favorite gauge for consumer prices. It came in hot, stubbornly entrenched, 3.3% year over year. And immediate casualty of this dynamic is the retail consumer. The U.S. personal savings rate has plummeted down to 2.7%. It's the lowest individual level since July 2022. And consumers are completely burning through those liquid cash buffers just to absorb the sticky everyday costs. Ultimately, I think importantly, just to kind of end the summer this up, if you understand how dangerous this setup is, you have to look at the plumbing. While the headline S&P 500 managed to look flat or slightly positive at points, I think it's an absolute illusion of stability that masked by a tiny handful of defensive heavyweights, and that's something that Reuters and Barron's talked about this week. The S&P 500 equal weight index, which really tells you how the 500 companies S&P is doing. Nobody really follows that because the S&P 500 market weight is what we all track. Market cap version is what we all track. And it makes it look good because, again, if the Mag 7 or whatever the top 10 companies are having massive, market cap, growth, then S&P 500 is going to do well. Equal weight takes all the companies in it. It fell off a cliff this week. It's now tracked towards its worst relative performance level since 2008. I don't know if you're hearing a pattern here. 2007s, 2008s. I don't know. That was an interesting time, Kirk. Some people may remember that. Many of the investors now didn't go through it. Some of the older investors might remember a little bit more about what that was like. Most investors have forgotten. Over 80% of individual equities are now actively dropping or flattening underneath the surface. And then you add in a massive global currency shock. I mean, the Korean markets absolutely crashed earlier this week. I don't know if anybody's been watching that, but there's rumors of an aggressive Bank of Japan rate hike that caused the Japanese yen to surge 4% against the dollar, and it violently unwound the global yen carry trade, which forced hedge funds to liquidate U.S. tech positions, some of which we've talked about, and you got the perfect storm. So, Kirk, institutional capital is aggressively playing defense. Market concentration is at a multi-decade extreme, with the top 5 stocks commanding over 28% of the index. And the late cycle cracks, again, we've seen a lot of late cycle, indicators been sticking out there for a long time. Some of them never really got to early cycle, even after the Great Recession. But they were kind of anomalies out here, right? A lot of other indicators continue to show early market, maybe mid-market. We are now starting to see an increasing number of late cycle cracks that are wide open. So, I think that, that this top heavy distortion, I think that the volatility crush, with a market, I think, we did see the VIX drop because the absolute event risk, the peak earnings and the Fed meeting passed. But I think, this is what we've been talking about, Kirk. We don't even have the impact of the rhetoric and the noise of the midterm elections coming up yet. And yet, as we're rolling into third and fourth quarter, there's already enough cracks that if that noise gets too loud, you could definitely see some things cracking open.
Yeah, I mean, so pretty much earnings season, I don't even think it's half over, but it's, a lot of the big companies have already reported. There's definitely some more. But as Doug says, the fireworks or lack thereof, time period is kind of past. We still have NVIDIA that's to report in a few weeks. And that's another one you got to hold your breath for. But outside of that, most people are just kind of riding it out. The interesting thing is, I mean, we're not going to have another earnings season until pretty much close to election time. And, we're still seeing decent numbers, but the market is rewarding earnings differently, than maybe last year. So the thing to think about here is, if we look at all the stuff going on, I do want to point this one thing out before I get back to that, because I didn't want to not hit it. But I finally realized, Doug, that our state, Massachusetts, we're number one. We're number one. We're number one. We're number one.
in
the highest cost of living in the United States.
Yes. Congratulations. You beat Silicon Valley. What an honor.
Yeah. $301,000 is the average cost of living in Massachusetts.
Oh, God, lucky you.
So proud. So proud. Good job, boys and girls. I don't know what Hawaii is. That's a deep blue too, but God, I mean, we're beating California, beating New York. What were we thinking? It pains me to live here. But,
I believe the saying is, "Thank you, sir. May I have another?"
Yeah. Well, it says here 100K is officially lower middle class.
Oh God, that's brutal.
Yeah, it's sad. It's sad, but it's only getting worse. And I think the stock market obviously is masking what's really going on in the economy. Now, in the stock market with earnings season, earnings are generally good. People think, oh, recession's around the corner. Yes and no. Not for the stock market, not for rich folk. We're nowhere near a recession. Things are great. If anything, it's going in the opposite direction. But if you're in the bottom part of the K, it's been a recession for a while, and no one cares about you because you're poor. That's why it's gotten this way, right? If people really cared about the poor people, then we wouldn't institute some of these ridiculous policies that we institute. Our federal government prints money, we spend money like it's going out of style, support all the rich friends and family and whatnot. And poor people, I just saw a great political ad. It's, I forget the guy's name, it was a Massachusetts guy. He's like, did so-and-so, and this ad's been on like nonstop. Did so-and-so give you money? No. And they're showing like a bunch of like average everyday Joes, like, tradespeople. And they're showing all these people, no, he didn't give me money. But he gave money to his rich friends, but they haven't given us any money. And it was brilliant. I mean, I don't know anything about the party or the person, but I was like, yeah, you're hitting the nail on the head with that one. You're hitting the sentiment of the populace. F you guys, you're taking care of the richers and not the poor folk. That's just the way we are. So we're going to continue to get the K-shaped economy. And, it doesn't mean the stock market's going to crash. It means it's going to be a lot harder to discern. And as Doug says, it's reminiscent of stagflation. This is why stagflation in the 70s and 80s was so challenging, because it's really hard to discern what's going on. You see one thing, you see another thing, it's not lining up as you think. You're like, well, I don't get it. Yeah, I know. That's the whole point. Our biggest challenge, I've been having this conversation lately with clients. Our biggest challenge is this. If I'm looking at the stock market, there's two different scenarios for potential outcomes. Scenario one, prior to the war, was low inflation, low interest rates, low oil prices, better earnings, better stock prices. That was scenario one. And that was working before the war. Scenario two is higher interest rates, higher inflation, higher oil prices, lower stock prices. That's scenario two. We're not really in either one of those scenarios yet. We're kind of in scenario two, except for the stock price. We have high oil prices, we have higher interest rates, they're climbing. Despite the Fed deciding not to do anything, the market still said, we don't believe you, and long-term interest rates are still going higher, as they should. There is a probability that the Fed is going to raise interest rates once before the end of the year. I think that's possible. Probably not before the election, probably after, but that I would suspect they're going to raise it at least once. I'm going to show you the dollar, because that's actually a good reason to make that change. But realistically, we're still in the funky middle. We don't know what to do. The market's going all over the place, but it's not really directional. Right? It's more indeterminate. Like, we think this is doing well. Now it's not doing well. This is doing well. It's not doing well. Here's a good example. Let me share the. Doug just polluted my feed with all this other stuff. It's going to be hard to find. All right, here it is. So if I look at where's the dollar? Here it is, the dollar. So here's some charts of what's going on in the markets. Oh, sorry, this is Bitcoin. Where's the dollar? There it is. This is the dollar. Okay. Everybody thought back in this is, I think, a year. But I would say within a year ago, people were like, "Oh my God, the dollar is going to crash. It's going to go down." Okay. If you don't know how to look at a chart, figure it out, because it is going to give you a lot better reason to sleep at night. People in the media talk about the dollar crashing. It was probably right around here, or maybe it was here. I don't know, but I didn't see a crash. There's no crash there. What you saw people jawboning it, saying it's going to go to zero. Oh my God, I need to get my money out of the dollars. What happened? It went back up, and then it went down, and then went up. We're in a range. We broke out of the range. Now we're back in the range. This is what happened with the Fed meeting. The dollar dropped from 101 down to 100. Oh, that's a crash. I mean, directionally, it's significant on this chart, but it's far from a crash. But the reason the dollar went down is because the Fed said, hey, we're not changing rates. Now, if they had the rates go up, that dollar would have gone up, because higher rates means more stable currency, meaning it's more balanced. The problem is, if we keep going higher, we really screw over emerging markets, and we screw over international markets. And Trump probably doesn't want that. He probably would have like it be in this range. If you've ever seen that clip from Landman, where he talks about oil prices, we don't want oil price $120. It doesn't work. We got to keep between 70 and 90. That's really where we're trying to target it. Between 70 and 90, everybody's making money, no problems.
$130, demand drops, and then that kills them.
Right, and then it drops it back down. So we don't want it too high. We don't want it too low. We want it right in the middle. The dollar's the same. They want it right in the middle where it's happy. It's just happy in the middle. If it gets too expensive, foreign markets struggle. If it gets too cheap, then it's better for us in some ways, but then it's worse in others. So there's no right place except for the happy middle. Now, sometimes you need to lower it to support domestic markets and whatnot, and sometimes you need to be higher. But generally speaking, right now, they don't want too much volatility. They want to keep this within that range. But this is pretty much what's happened. International markets have gone sideways for the last few months. Sorry, I didn't put the time scale on there. I probably should have. But the bond markets actually have not been doing well. Those do not look good. So if you own long-term bonds, you should have been out a while ago. I would not be holding those right now. You want to be very, very careful about long-term bonds. You got the Nikkei. This is the Japanese market. I'd be a little careful about being raw in the Japanese market because there's a big currency risk out there. But if you're hedged against currency, it's perfectly fine. Japan's a great place to be. It's one of my favorite places. So here's South Korea. Okay. South Korea went up to 9,200 and then it hit around 50 something, 5,700. And then it bounced. Well, that's because they have a concentrated stock market primarily. But all these people like Stan Druckenmiller said, "Oh, you gotta invest in the Kospi. You gotta do all this. It's great." And I'm investing in South Korea. Yeah, until right here, and then the war started, and then it didn't do so hot. So I would steer clear of Korea. I don't understand the market well enough to speculate. I understand Japan and South Korea. I don't understand well enough. I don't understand what everybody's talking about. I get that there's tech companies there, and that's probably it. But to me, that just seems like a dumb reason to. Gold has pretty much dropped most of this year and is flatlining, which is where it is now. I suspect it's probably going to drop below this line and scare the pants out of people, and it's going to cause people to get bounced out because that's what Wall Street does. I would probably accumulate a little here, but I would definitely look to buy on a break below this because I don't think that break will survive long. As long as we have the war, a lot of other countries are selling their gold in favor of cash because they need to pay their bills. Turkey did this. A few other countries did this. That's one of the reasons why gold is getting crushed, is because foreign countries are selling their reserve assets to free up cash because of the war. So if the war doesn't end, then we might see more of this. But in general, I think it's a great opportunity to own gold if you haven't bought it. I do think there'll be a better opportunity, and I don't think we're out of the woods with gold. I think we've got another year or two left before gold starts to pick up again. So just my thoughts. Bitcoin, as you see here, we've seen a stair step down. We're seeing support now, but my target is right around half of where it is now. I don't know if it'll get there, but that's what I would suspect. I would look towards the end of the year as a good chance to look at it because there'd be a lot of tax loss selling at the end of the year for Bitcoin. End of December, I would just watch it. If it's low and going lower, it'd be a good chance to take a short-term flyer, and if it keeps going, you get out. But I would say end of the year is probably a good time to start looking at it. Russell's actually been more relative strength than the other indexes, small cap, especially small cap value. Obviously it's going sideways for the last few months, but definitely if you see these other ones, if you look at the S&P, which has been sideways right now, it's right smack in the middle of the range, uninteresting altogether. And then you've got the NASDAQ, and this is the range the NASDAQ was in, and it broke below that earlier this week. I think it started on Friday and then broke below. And then on Thursday, when Citadel cleaned out the WizKid, it broke back up, and now it's kind of really close to on the line, give or take, whether it's on the line or above, depends where you draw it. But ultimately, right here, I would watch to see if next week the markets follow through in the upside or in the downside. I wouldn't take a bet. I would wait till it shows you, and then you could probably jump in and make a directional bet. But this is what I was talking about earlier. This is a really important thing to watch. The markets go through these. We went through from September until March. We were in a sideways market with big tech, and then we broke down with the war, and then it came back and went flying up a huge amount. Now we're in another range. It's uninteresting when it's in a range. You could say, "Oh, the tech's going up." Is it? I don't know. I'm not buying it. I would say this is a good reflection of tech in general, and I would not be a buyer here unless we start to see follow through from this support. Because this is a false break and it goes back, that's actually bullish. So I would buy on that. But if it breaks down, that's bearish, and I would stay far clear away from tech until that direction becomes more sound.
And so, I've got a thought on the tech when you're done. I want to come back to because on something you mentioned. So
I want to hit one more on the tech, and then I'll hand it back to you. So here's a tale of two cities here. Okay. I wanted to share this. I've shared it before, but I wish I could put these side to side. I don't think I can on this. All right. So here's two companies, and I'm sharing the revenue, net income, and EBITDA. Okay. And then below, I'm sharing operating cash flow, free cash flow, net income, blah, blah, blah. Okay. So the top is earnings, revenue. The bottom is cash flow and a bunch of other stuff. Okay. So the top one, it shows it's grown a little bit. The last few years hasn't grown all that much. Earnings have not grown much at all. Net income, not much at all. You look at the bottom, cash flow, The last few years been a little rocky. So it looks like it's,
Kirk, are you trying to show something? Because there's nothing.
Oh, sorry.
That's all right.
Thanks, Doug. Thanks for pointing that out. Okay. So here's company A. As you can see, last few years, really gone nowhere. Earnings, revenue, EBITDA, income, and cash flow, same, just sideways, right? There was sideways, then it went up a little bit, then more sideways, not really growing all that much. Strong numbers, but not growing that much. Here's company two. Company two, revenue grows every single year, earnings grow every single year, net income grow every single year, you have cash flow growing every single year. Everything's growing on number two. Which one out of these two would you buy, Doug?
The revenue growing every single year.
Yeah. I mean, it's a visual absurd, like it's visually obvious. Do you buy a company that doesn't grow that much, or do you buy a company that grows every single year?
I was waiting for the trick. I was waiting for the trick question, that Kirk. But
no, it's not a trick question. I'll share what companies they are. But the point being is these are two big tech companies. Okay. And out of the two big tech companies, which ones do you think they are, Doug?
I think I know which one of them. Does one of them the competitor of my cell phone?
Your cell phone?
I use a Samsung. Is one of them a competitor to that?
Apple. Know. Yes. Okay. Yeah. Yes. One of them's Apple. This one here is Apple. The one that's not growing. And then you look at the other one. What do you think the other one is?
Ooh, there's a lot of companies that are growing. Google?
Not many.
Oh, yeah, good point. Google?
Nope.
NVIDIA?
It's in the Mag 7, not NVIDIA.
Oh, Netflix?
Mag 7. Nope.
I got to go back and look who's in it currently.
Okay. So
yeah, go ahead.
It's Microsoft.
Caught me off without looking. Sorry.
It's no worries. Yeah. So just
is it Microsoft?
You. It's Microsoft.
There you go.
This is Microsoft. This is why I like the company.
I told you everybody's dogging them, but look at them.
Everyone was dogging them till earnings. Now all of a sudden they're the hero. But the reality is this company is a cash machine. It's minting money. They're not the only. There's a lot of companies that look like this. I'm only using them because off the top of my head I knew it would look like this. So you look at a company like this and you say, I would rather buy this than this. But yet everyone loves Apple. I don't get it. I'm not saying Apple's a bad company. Sure, they haven't innovated since Steve Jobs died. Sure, they've dumped tons of money into programs that have turned out into nothing. And the last innovation they had was the Apple Pen. And they haven't grown revenue or earnings in a long time, but yet they keep increasing the price on the stupid phones because I get another megapixel. I don't get it. Yet the market seems to get it. The market says, hey, it's fine, at least except for this week in earnings, which I think it's down like close to 10% today. But it doesn't matter because 10% is nothing. It hasn't gone. The stock price hasn't really moved in a while. And so I look at this. This is why markets are inefficient, and this is why you can find opportunities in the market. I'm not saying Apple's bad, Microsoft's good. No, I'm just sharing the numbers. These are all public. Here are the numbers. Look at them yourself. You make the decision. I'm saying just looking at the numbers alone, just looking at the pattern of the numbers, which one do you prefer? Doug didn't know what they were. But he saw it. He said, yeah, I want this one. Yes, everyone in their right mind should say the same thing, right? Unless you're cuckoo, you should say that. But yet a lot of people invest in companies that have revenue charts that look like this. It's insane. And I'll share some others, but maybe next week when we have more time. But generally speaking, this is, investors don't look at this. Investors are like, is the company going up? Let's buy it. Is there potential for it to go somewhere in the future? Let's do it. Apple is going to become the new IBM. It's just going to be stagnant for like decades because it's not innovating. Mm-hmm. And yet people still give them a high multiple. If you have a high multiple, it means you're going to grow. They're not growing. Why do they have a high multiple? I don't know. So when you're looking at investing in individual stocks, you need to understand the fundamentals and the technicals. You need to understand all of it. And if you see something that doesn't make sense, just move on. I don't understand Apple. Doesn't make sense to me. It's not growing. People give it a high multiple. Great. I'll go do something else. It's not a bad company. I own their phone. I got one myself right here. But, doesn't mean I have to invest in the company when another company is growing much better. Now, people speculate that software, AI is going to kill it and a lot of people don't want to touch it. I get it. Totally get it. But Microsoft's minting cash flow. just like Google. Google's minted cash flow, right? You could argue whether their business model is going to get screwed up because of AI, maybe, but at the end of the day, when's that going to happen? It's not going to happen tomorrow. It's certainly not going to happen today. Maybe it'll happen a few years from now. That's plenty of time to pivot. But until then, I'd rather pick the cash machine that's going to increase their cash flow every single year. They're going to increase their revenue, and they've got pricing power. Are you going to stop using Windows? No. Am I going to stop using Office? Not tomorrow. If you're a business owner, no, not for a few years. And even then, I mean, I use Google Suite instead of Microsoft. Some people like Microsoft. I think Doug uses Microsoft Office, but there's basically two competitors and they're both pretty similar. And if as a business owner, I need to use one of them. It's just practically speaking, I need to use one of them. So people are going to pay for this stuff and it may change, but what's more likely? That one of these two companies is going to integrate AI into their platform, or Doug is going to come up with a new platform from scratch that everyone's going to start to buy because it's so much better than these two? No, they're going to use what's easy and proven and everyone else is using it. That's what business owners are going to do. So you can say what you want about big tech. I'm not a lover of big tech in general because I think it's too expensive. But if I was going to buy one, I'd look for a chart that looks like that, not one that looks like this. And there are some Mag 7 that look like this that is not this company. So I'll pull them up for next time so you can see them all and you can judge for yourself. But that's what you want to look for. And most people should not buy individual stocks, but if you do, that's one of the things you should look for. What else? Where else do you want to take us, Doug, before we wrap it up here?
To defend myself from looking a little bit foolish, the Netflix.
You didn't look foolish.
No, the Netflix call. I just want to let everybody know I was going old school. That was pre-2020. Back in the dark ages. That was FANG. Yeah, I went FANG. I went FANG instead of Mag 7. You know what? So just a little trivia quiz. The differences between FANG and Mag 7 are which companies?
Netflix and
Netflix is out. Yep.
Well, Facebook they changed.
That's the same. Meta.
So it was Facebook, Apple, Amazon, Netflix. There was another NVIDIA and Google.
NVIDIA was not in FANG. Google was. It's Alphabet. It's in both of them. The new ones to Mag 7 are NVIDIA and Tesla.
Yeah.
Yep. And the one that's out is Netflix. So I was close. I wasn't pulling I wasn't swinging at air balls there. So
no. You're close enough. I'm testing Doug on the air. He doesn't have insight into what I'm sending him. So
yeah. No, I thought about that. I was like, geez, how far off was I? I'm like, I thought it was. Yeah, that's right. It was FANG.
Yeah, there's 5,000 companies. It could have been any of them.
Correct. Yes. So I did want to bring something up. You mentioned earlier. This is a tech thing, and I know we got a couple minutes and I'll close it out. But you mentioned that one of the big ones coming up here, and it hasn't reported yet, we just talked about, is NVIDIA. Their scheduled call is actually not for about a month. It's August 26th. But I think this is really important to understand with what's going on in AI and tech right now. And I think to me, it is it could be a great opportunity, but I think it's a very concerning, something that needs to be really watched. And here's an example. There is an Ohio project that's come that they've just announced. And I think it exposes a massive hidden structural risk that could completely overshadow upcoming numbers. It is a $500 billion Ohio mega project. The sheer terrifying scale of this. They're in advanced talks with OpenAI to provide a jaw-dropping $250 billion financial backstop. And this isn't a standard tech partnership. This is literally NVIDIA acting as a sovereign-level central bank to guarantee a massive 10-gigawatt data center campus in Pike County, Ohio, my home state. The complex is being driven by SoftBank's SB Energy. It's funded via an intricate international energy deal where Japan is deploying $33 billion into a natural gas power project on U.S. federal land. And by the time you fill the data center with high-end processors, the total project cost is projected to cross $500 billion, making it the largest infrastructure project in human history. But here's the issue and why, institutional investors look at this headline and some of them, the blood runs cold because it does flash a major red flag. It's called extreme circular financing. If you think about mechanical plumbing of this deal, NVIDIA uses its massive cash piles, pristine corporate credit. It guarantees up to $250 billion in debt and leases for OpenAI. Separately, NVIDIA negotiates a parallel structure to directly finance up to $350 billion of OpenAI's chip purchases for the exact project. OpenAI then takes the subsidized vendor finance money, hands it right back to NVIDIA to buy their next generation Blackwell and Rubin graphics processing units. So the casual observer, it looks like booming revenue on paper. I mean, this is kind of some of the stuff like MCI and WorldCom were pulling off here, which is why, so to a short seller and a macro analyst, it looks like these late 1990s dot-com bubble vendor financing schemes where companies like Cisco and Lucent, they loaned billions of dollars to unviable telecom startups. And I'm not saying that that's the case, but right now, financially, AI companies are just hemorrhaging. Just so those startups could buy the Cisco hardware. Like, here's the money you give back to us, right? So we lend it. So now we've got this, the accounts receivable on the books. And at the same time, you're going to buy our hardware with it. And that inflates inflated Cisco's quarterly revenue figures. If NVIDIA has to become the primary bank, lender, and backstop for its own customers, which this is not the first time it's done this, just to keep its order books full, it heavily implies that traditional commercial banks, hyperscalers, and venture capital firms are quietly refusing to fund these multi-billion-dollar AI build-outs on their own. And it signals that organic third-party demand for these massive clusters might be drying up, could be forcing NVIDIA to take on massive balance sheet and customer credit risk to manufacture its own future growth. So I would say let's watch that very, very, very closely. The other thing to watch, sovereign debt crisis, 1980 versus 1920 or 2026. 1980 U.S. debt to GDP was a manageable 31%. It's now at a staggering 120%. We basically just passed our debt is now over our GDP, which is, that again, that does have a domino effect. And the consumer, I have a chart on there that shows how the consumer is getting squeezed. Food prices skyrocketed 33% since 2019. Consumers are exhausted. And personal savings rate, as I mentioned, has crashed. I do want to give a little silver lining before I close it out here. If you look at valuation data, the one thing that's still, when we look at the markets, the NASDAQ 100 blended forward 12-month price to earnings ratio, this is not 2001 when people scream, that we're repeating the dot-com bubble explosion. They're ignoring basic valuation math. At the peak of 2001, the NASDAQ 100 was trading at completely detached, hallucinatory 86 times forward earnings. The current metric now, we're about 24 times forward earnings. So this isn't a speculative bubble built on empty promises and zero revenue. The reason multiples are compressing down to 24 is because the tech giants are generating historic, unprecedented rivers of actual earnings. Underlying cash generation is real, and the drop is in the start of a multi-year structural collapse. It's a healthy late cycle multiple reset, clearing out weak hands and creating the most attractive valuation points that we've seen in 18 months. But again, I would be a little bit cautious when we start to look at the possibility and the impact of things like what NVIDIA is doing. So as we wrap up, closing it out, I want to leave you with one thought, okay? If you're in your late 40s or you're in your 50s or maybe your early 60s, I got a question for you. Are you still investing like someone who's building wealth, or have you started planning like someone who's about to live off it? They're completely different things. This week alone, we talked about AI spending, Apple falling while Amazon soars, Microsoft adding nearly $500 billion in market value, tariffs, oil, bond yields, Fed, NVIDIA, geopolitics. If you're not careful, it's easy to start believing your retirement depends on getting every one of these headlines right. And it doesn't. That's Wall Street's job. Your job is different. Your job is to making sure that 20 or 30 years from now, your paycheck still shows up, whether the market's up or the market's down, whether inflation surprises us or doesn't, AI changes the world or simply becomes another technology cycle. Here's something I see all the time. Financial media is entirely built for accumulators. Buy this, sell that. Own more of this. Don't miss the next big thing. Very little of it's designed for someone who's asking a completely different question. How do I turn everything I build into a paycheck I never have to worry about? Retirement isn't measured by your account balance. I know a lot of people think that. It's measured by confidence. Confidence in inflation won't erode your lifestyle. Confidence in bear market in your first few years of retirement won't permanently change the future. Confidence that taxes won't become your largest retirement expense. Confidence that if one spouse passed away, the surviving spouse is okay. Confidence that if you live to 95, your money does too. And maybe the biggest question of all, when was the last time you went an entire week without worrying about money? Think about it. Not checking your portfolio, not worrying about the next Fed meeting, not wondering whether NVIDIA beats earnings, not asking yourself whether it's the right time to retire. Just living. Because isn't that what we really spent the last 30 years working towards? To stop worrying, enjoy family, grandchildren, lake, golf course, hobby farm, trip you've talked about for years. Freedom to wake up Tuesday morning and ask, what do I want to do today? Instead of, what's the market doing? At Merchant Advisors, this is why we don't start with investments. Start with your life. If we're recommending anything, we map everything: income, taxes, retirement paychecks, college, healthcare, estate planning, the risks you can see, the ones you can't. The goal isn't beating the market. It's reaching a point where the market no longer dictates happiness. If you found yourself listening today and thinking, I think we're okay, but I don't actually know, don't ignore that little voice. It's usually not fear. It's your intuition telling you it's time for clarity. Visit us, mergentadvisors.net, MERGENT, mergentadvisors.net, because retirement isn't about accumulating enough money. It's building enough certainty that you can finally stop thinking about it. And I'll leave you with this. The greatest sign of financial success isn't having more money than your neighbors. It's waking up one day and realizing you no longer need to ask what the market did yesterday. That's financial freedom. See you next time.
Great. Thanks for coming on, Doug. I'm going to share one or two quick things just because tie into the things I just said. One thing I want to share, and we'll go over this next time, is drawdowns before the election. We're going to share it next time because right now there's an opportunity to look at. This is kind of a fear chart that people send out, but it's also a very interesting one. The things I really wanted to share are this. If you look at the two companies we just shared, we're two companies out of the Mag 7. But here are the rest. Okay. So here's Google. This is Google's chart. Looks, very similar to Microsoft's. It's going up each year for both EBITDA and revenue, give or take. Cash flow is increasing. All good stuff, right? That's a good chart. You look at the next one. The next one is NVIDIA, right? Also, up and to the right, although a bit more extreme. Makes me a little less comfortable just because you don't have that history of it happening over long periods of time. But still good, right? Still going up each year, earnings, income, revenue, all that stuff, cash flow. Good stuff. That's a good chart. I'm not looking at like stock charts. I'm just talking about financial charts. So if you guys aren't listening, you should go watch the video of this because I think it's a really important lesson to look at. All right. The next one is Meta. So I'm not a huge fan of Meta, but you look at their revenue, their earnings, same thing, generally going up and to the right each year. Cash flow, same thing. So that's good, right? It's a good looking chart. And I'm spending 5 seconds with each of these, by the way. I'm just trying to share the impression here. Here's another one. Here's Amazon. It's nice the revenue's going up. The earnings are not going up quite so much. That concerns me a little bit more. I know they have a low profit model, but cash flow is a little bit more lumpy. And don't love the revenue's fine, but I don't love the earnings stuff with Amazon. I think they need a more high profit margin model, but I do like the direction. They're going in the right direction. So all good things. Here's Tesla. So Tesla, a little more lumpy. The last few years hasn't moved for revenue. Looks like earnings have declined a little bit. Cash flow is also lumpy. You can it's hard to discern between this, but little more hard to discern, a little lumpier, a little less pretty. You look at the next one. The next one's Eli Lilly. I tried to pick some random companies out of the S&P 500, bigger ones. So if you look at Eli Lilly, it's up into the right with revenue. Earnings the same. A little steeper recently than before, but all that because of their new drug meds. Cash flow same, going up recently. All good stuff. Then you've got. Next one's Walmart. You look at Walmart. Walmart is just one of those companies that continues to grow. Not as pretty as some of the tech companies, but as you can see, the revenue is growing. hard to show whether the EBITDA is growing on the chart, but it's generally a low margin business, high volume. You look at the operating cash flows, all strong. They're not growing so much, but it's strong. And then you look at, let's see, I think we had one or two more. Okay, so we had two more. We had Coca-Cola. Coca-Cola, not so pretty. It had a dip there a few years ago, and now it's back. A little more flat, not as much growth. Cash flow is still strong, but as you can see, cash flow for dividends are increasing. The cash flow, not necessarily. So that's maybe a little bit of a risk you want to concern yourself with. Not to say they're going to shrink the dividends, but that would certainly be an issue if that chart persists. And these are companies I'm not worried about. I'm just sharing just off the cuff remarks just from looking at the financials. And this one is, what did I say this one is? Last one is, McDonald's. Last one is McDonald's. So as you see here, same thing as Coca-Cola, had a dip coming back. Earnings kept increasing, but the revenues dropped and then came back. Cash flow is still strong. It needs to be able to offset the dividends. So that's at some point an issue. Doesn't seem to be at the moment. So, this is kind of this is why people like tech, right? You see those tech charts, they look the best. Earnings, earnings were good in comparison to revenues. They're all going up. So you can find good companies out there, and there are plenty more. I just shared a few, but those are the kind of things you want to look for when you're looking at a stock. Not just a stock chart to see where the price is going, but actually where the fundamentals are going. Is it increasing? Is it going up? Is there a prospect for it to increase? You don't need to do a year's worth of research on a company before you invest in it. That is sufficient enough to at least say, should I pay more attention? I don't even know what the numbers are. I just know visually they're going up and to the right. That's what you want to see. Now you can do your due diligence. You don't need to spend hours and hours to figure out the right ones. Just look at that. Look at the financials. It looks good or it looks bad. You can decide whether you want to dig deeper. But anyway, so I just wanted to share those just as a follow-up to what I was saying. But we're going to wrap it up here. So that's the show for this week. Thanks again for joining us, the Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Missed something on the episode? Looking for the show notes? Check out our show at moneytreepodcast.com. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you're seeking financial advice, give us a call. We take clients selectively, but only if we like you. So if it happens that we don't like you, there are plenty of advisors out there who work with anybody with a heartbeat and two nickels to rub together. Like I said, we're selective. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.